This video is created by Jagrat Creations. It is on amalgamation of partnership firm. This sum is useful to the students who are reading for intermediate CA. Observe the sum on the screen, which I intend to solve. Read it carefully. I just present the entire screen here before you. While observing the video, you should pause the video and read the sum carefully. Now I want to explain the contents of the sum and the method for solving the sum. M, N and O are the partners sharing profits and losses in the ratio of 5:3:2. The trial balance of the firm as on 31st of March 2017 is given to you. In this trial balance, you are given machinery, inventory, trade receivables, trade payable, capital M&O, drawings M&O, depreciation, profit for the year ended on. So this is the profit for the current year. So partners have yet not distributed the profit. So the capital balances are the balances wherein profits are not added and drawings are also seems to have not been deducted. So this is a trial balance as on 31st of March 2017, but the capital balance is an opening balance because it seems that the profit is not distributed. Profit, depreciation on machinery, cash and bank balance. Interest on capital at the rate of 10% per annum on the amount standing to the credit of partner's capital account at the beginning of the year was not provided before preparing the above trial balance. So, partners are entitled to have an interest on capital at the rate of 10%. So, from these profits available, we are required to give interest to the partners at the rate of 10% on the opening balance of partner's capital account. Whatever the profit is left thereafter will be distributed in the ratio of 5:3:2. Now, this is a sum on conversion of a partnership firm into a company. On the above date, they formed a company named M&O Private Limited Company with an authorized share capital of 2 lakh in shares of ₹10 each, divided into different classes of shares. Now, you are required as under. So here, this is a sum on conversion of a partnership firm into company. Remember one basic principle. For sums on amalgamation of partnership firm or sums on conversion of partnership firm into a company, whatever the transaction that has occurred prior to the date of conversion should be recorded first of all. Here, which are the transactions need to be recorded are appropriation of profit that has occurred during the year which has not yet been distributed. That I will record first of all, and I will find out the capital balance existing at this date of trial balance. And all these transaction drawings to be deducted from capital, interest on capital is to be given, profit is to be distributed. All these transactions are the transactions of pre-conversion. So first of all, we have to enter into the transactions which are pre-conversion. Now, you are required as a machinery is to be transferred at 1,40,000. Now see, machinery book value 2 lakhs. Depreciation on machinery is 80,000. So 2 lakhs minus 80,000, book value of machinery is 2 lakhs minus 80,000, 1 lakh 20,000, and this machinery has been transferred at a price of 1 lakh 40,000. So there is a profit that occurs at the time of conversion of a partnership firm is 20,000, and this profit will be distributed amongst partner in the ratio of profit sharing ratio. Next point. Shares in company are to be issued to the partners at par in such numbers as in such classes as will give the partners by reason of their shareholding alone the same right as regard to interest on capital and share in profits and losses as they had in partnership. This is a very important statement given to you in the sum. Now partners are prepared to convert their business into a company. But their understanding is, whatever the manner in which they had shared the profits in the partnership firm, the sharing of the profit should occur in the same way after conversion. This is the understanding of the partners. Now how the profits were distributed in the partnership firm? Out of the profits, 10% interest on capital is given. Now in case of company form of organization, you can never give interest on equity share capital. But if instead of equity share capital, if the preference shares are given to the partners, and if the dividend rate on preference share is 10%, then 10% dividend on preference shares can be equated with 10% interest on capital. So partners should be given preference shares on which they should receive dividend in such a manner as they have, which is equal to the interest on capital that they have received in capital in a business firm identified as partnership prior to conversion into a company. So here the share capital is 1,36,000. Partners are entitled to have an interest on capital at the rate of 10%. So 1,36,000 into 10% is the interest on capital is to be received by M. Same way, 90,000 into 10% is the interest on capital is received by partner N. Now after conversion, they want to have the same amount of interest. So the partners will be given preference shares to M equal to 1,36,000, and the rate of preference share dividend will be 10%. So after conversion, M will get just allied to interest on capital, preference share dividend 13,600 rupees. So N capital 90,000, he was getting interest at the rate of 10% on this capital 9,000. He wants to have the similar amount in case of company after conversion. So if he is given the preference shares of rupees 90,000, then he will get 10% dividend there on 9,000, which is that amount is equal to and alike to interest on capital. Now this is how the preference shares are to be given in exchange. Now whatever the assets and liabilities are purchased at an agreed value by the company or transferred to a company at an agreed value, from those assets and liabilities, we can find out the net assets. That is, the purchase is made by the company, or these are the assets and liabilities transferred to the company by the partnership firm. So net assets we will work out on the basis of information given in the sum. So that is, net asset is considered to be a purchase consideration. From that total purchase consideration, the preference shares are to be given for this value, and the remaining consideration will be paid in form of equity shares. And those equity shares will be distributed in the profit sharing ratio amongst the partners. So an equity dividend that they may receive in company after making payment of preference share dividend, whatever the equity dividend that they should get in the profit sharing ratio. So whatever the equity shares are received on conversion of a partnership firm into a company, those equity shares will be distributed in the profit sharing ratio, that is 5:3:2. This is the explanation of this statement 2 that is very important. Now I want to talk about third point. Of course, I am going to apply this principle that has been explained to you while solving the sum. Before transferring the business, the partners drew from partnership profits is to such an extent that bank balance is reduced to 1 lakh. Now bank balance is 1,76,800. 1,78,600 is the bank balance. That is reduced by partner to the extent of 1 lakh. And that bank balance is transferred to the company. So 1,78,600 minus 1 lakh is the amount 78,600. That is the cash balance left available to the partners after conversion of a partnership firm into a company. And that cash balance will be distributed amongst partners. Now, as you know, the partnership firm is dissolved. Because the partnership firm is converted into a company, the preference shares are to be given to the extent of this capital. The remaining equity shares are to be given in profit sharing ratio, as I have explained to you. Now the balance of capital amount will be paid in cash, and that cash payment should be equal to this 78,600, because out of total 1,78,600, 1 lakh is going to be transferred to the company. So this is the understanding of this third point. Assets and liabilities except machinery and bank balance, that is 1 lakh, are to be transferred at their book value on the above date. So remaining assets and liabilities are transferred at that book value. I am required to prepare statement showing the working of number of shares of each class issued by the company to the partnership firm, capital accounts and all adjustment required to dissolve the partnership firm. Balance sheet of the company immediately after acquiring the partnership firm is required to be prepared. Now, after explaining this sum, I will start with the sum. What I will take care of, first of all, what I will do? I would like to distribute this profit for the year after paying interest on capital at the rate of 10%, and that profit will be distributed after interest payment in the ratio of 5:3:2. By that, I will get the capital balance as at the date of balance sheet. Second, machinery is transferred as 1,40,000. Profit on transfer of machinery is 20,000. That will be distributed amongst partners in the ratio of profit sharing. That is my next step. After that, I will get the ultimate balance of partners' capital, which I require to redeem. Now, all these assets and liabilities are transferred to the new company. Bank balance is transferred to the tune of 1 lakh. Machinery transferred at 1,40,000. Remaining assets and liabilities are transferred at book value. On the basis of that, I will find out the purchase consideration required to be paid. That purchase consideration required to be recovered from the company by the partnership. In that total value of purchase consideration, I am going to get the preference shares for this capital, and remaining amount will be equity shares. These preference shares are to be given to the partners as you find on the screen, because they want to have preference share dividend equal to interest on capital. And the equity shares will be distributed in the profit sharing ratio. And the balance amount of capital will be paid in cash. This is the procedure in which I am going to solve the sum here before you. Let me start. So this is the details of the sum which I have once again brought on the screen. Because while solving the sum, I am going to have a reference to the contents of the sum. As I told you, first I will prepare capital accounts, profit and loss appropriation account. I will write the opening balance of capital account in the capital accounts on the credit side, M, N and O. Drawings during the year will be debited to capital account, M, N and O. Profit for the year recorded to the credit side of profit and loss appropriation account. From this profit, I am required to give 10% interest on capital. So 10% interest on capital. The opening balance of capital account of M, 1,36,000 into 10%. For N, 90,000 into 10%, 9,000. For O, 46,000 into 10%, 4,600. Interest on capital is credited to the capital account and debited to profit and loss appropriation account. Same way for N. Profit and loss appropriation account debit to capital account credit. Same way for Q. O. Profit and loss appropriation account debit to capital account. Now, from this profit, interest on capital will be deducted. So I will get the profit. So 2,48,600 minus 27,200. This is the profit, which I will distribute in the ratio of profit sharing, that is 5:3:2. So this profit distributed in the ratio of 5:3:2. So 5/10, then 3/10, then 2/10. This is the profit distribution. Profit and loss appropriation account debit to partners capital account credit. Profit distribution is done. Now I will take care of machinery transfer at 1,40,000. And also I am going to prepare a purchase consideration. Here I will write down the details of purchases made by the company or the assets and liabilities transferred by partnership firm to the company at an agreed value. And here, whatever the payment is made by company to the partnership firm will appear here. Now, first of all, machinery transferred to the company at 1,40,000. As I explained to you, the cost of machinery in the books 2 lakhs minus depreciation 80,000. So machinery transferred at what price? 1,40,000. How much is the profit on transfer? For that I prepare a working note. The exchange value is 1,40,000. Book value 2 lakhs minus depreciation 1,20,000. Profit 20,000. That is distributed in the ratio of 5:3:2. This profit is credited to the capital accounts of the partners. 20,000 into 5/10, 10,000, 6,000 and 4,000. This is how machinery transferred at 1,40,000. Profit on transfer of machinery credited to the partner's capital account. This is how this first point is addressed. Now, as I told to you, bank balance is 1,78,600. Out of that, bank balance kept in the business for transfer 1 lakh. So bank balance transferred to the new company 1 lakh. So new company purchased the bank balance of 1 lakh. The remaining bank balance 78,600 will be available to the partners at the end. So 78,600 cash balance will be distributed to the partners, as we usually do in case of dissolution of a partnership fund. When we close the capital accounts of the partners and the balance in capital account is paid to the partners, at that time the payment will occur to the partners to the extent of 78,600. That is an important point to be noticed. Now remaining assets and liabilities are transferred at book value, inventory at book value. So this is purchases made by the company. Trade receivables, book value. Trade payables deducted from total of assets. So these are the assets and liabilities transferred. Now this is the capital balance payable to each partner. How this purchase consideration is going to be received? In form of preference share to ensure 10% preference share dividend, which is equal to 10% interest on capital. So these partners will get preference share capital issued keeping parity with interest on capital. Now they are getting interest on capital 13,800. We have presumed the rate of dividend on preference share to be 10%, as it is not given to us. So 1,36,000 preference shares will be given. Suppose that if you are given the dividend rate on preference share in the sum, then this 13,600 is required to be divided by given rate of preference share, so that you can find out the principal value of preference shares exchanged. Here in this case, interest rate and the preference share dividend rate is presumed to be same. So 1,36,000 is a preference shares that will be given to M. Same way, 9,000 interest is to be paid by 10% dividend, so 19,000 preference share capital is to be given, and to owe 4,600 divided by 10%, 46,000 is the amount of preference share to be given. So these preference shares are given to the partners. So partners are the receiver, and this preference shares 2,72,000 that we have received in exchange of purchase price of the business. So preference shares 2,72,000. Now how much equity shares are received? Total of assets minus liabilities. We will get the purchase price. From this purchase price, we have already received 2,72,000 by way of preference shares. So remaining amount, total of assets 5,01,400 minus liability 3,32,000. 3,32,000 is to be received. Against that, we have received the preference shares of 2,72,000. So remaining amount is received by way of equity shares, and these equity shares will be distributed amongst partners in the profit sharing ratio. So when the company gives equity dividend, the partners will get equity dividend out of profits in the profit sharing ratio. So this equity share capital is also required to be distributed in the profit sharing ratio to ensure that, as agreed by the partners, that partners should get share in profit exactly in the same way in a company after conversion as they were getting in the partnership firm. So these equity shares are also required to be distributed in the profit sharing ratio. So 5:3:2. So 5 by 10, 30,000. 3 by 10, 18,000 and 12,000. This is how the equity shares are given. After making payment against capital, preference share and equity shares, balance amount is to be paid in cash. For that, we have got available cash balance 78,600. So total of credit side minus total of debit payment made. So cash required to be paid is 54,300 to M. So 2,70,300 minus 50,000, 1,36,000 and 30,000. This is the amount to be paid to M. Similarly, 1,71,420 minus 46,90 and 18,000. This is the amount required to be paid to N. And same way, 98,880 minus 34,000, 46,000 and 12,000. So 6,880 cash is required to be paid to third partner. So this is the payment to be made in cash. Make a total of this payment made in cash. So if you make a total 54,300, 17,420 plus 6,880, this total will be equal to 78,600. Confirm it. If this confirmation occurs, then your sum is right. So this is how this sum on amalgamation is solved. Now let me represent the same details on the next screen. That this is a solution that I have prepared for you. Now I am required to prepare the balance sheet in the books of company. This is the balance sheet that will be prepared on the basis of this purchase consideration. These are the purchases made by the company. This is the liability purchase. This is the payment made by the company. So this is what company acquired. This is what the payment is made. So I will prepare the balance sheet in the books of company after conversion in this format. So equity and liability, shareholders fund, current liabilities, then comes assets, non-current assets, current assets. You know this format. Now shareholders fund 332,000, that is made of equity shares and preference shares. Machinery, non-current asset. Bank balance, cash and cash equivalents. Inventory, current assets. Trade receivable, trade means debtors. Trade payables will go in current liabilities. Now have a total of balance sheet 5,01,400. This is how the balance sheet in the books of company is being prepared on the basis of this purchase consideration statement. This is a very important sum from examination point of view. I have tried to explain you this sum. I feel that you have followed. Thanks to all of you.